Bloomberg Audio Studios. Podcasts, radio, news.
We begin this hour with a leadership shake-up at Bank of America. Brian Moynihan recently naming Dean Athanasia and Jim DeMare as co-presidents. The firm writing in a statement, quote, Athanasia and DeMare will drive company-wide initiatives focused on long-term growth and returns and oversee Bank of America's 8 lines of business. I'm very pleased to say that joining us now is the Bank of America Chair and CEO, Brian Moynihan. Brian, of course, in London, and we're here in New York. You're actually in our home and we're in yours. So thank you, sir, for making that happen. Brian, let's get to this leadership shake-up because we've got a lot to talk about. 8 lines of business, 2 very prominent individuals in this bank, at this institution. How do you and the team plan to split up responsibilities?
Well, it's good to talk to you both, and thank you for coming to our great corporate headquarters. Hopefully they're treating you nicely out there. This is a recognition of 3 teammates, Dean and Jim and Alistair, and the contributions they made to our company and bringing Jim and Dean to help me leverage across the businesses. And there's a lot of initiatives we conduct across the company, our growth work streams, our operational excellence, our AI initiatives and things, and I've asked them to come help me. Meanwhile, it also frees up space for that talent group, and you're talking to a lot of them today, whether it's Lindsay or Eric or Wendy and others that continue to drive those 8 businesses for us and own the businesses, own the responsibility for P&L, and there's a lot of talent at that level. So the idea is to bring them to help leverage my time, leverage the company's time, leverage the company-wide initiatives, and then let that talent that drives those businesses keep making great progress.
Brian, there is an obvious, perhaps uncomfortable question. Some people might have responded to this and just thought, is Brian setting up for succession? Or is this just about changing how the company's ran?
Well, long term, we have one of the duties that I and the whole management team owes the board of directors is a series of candidates that have the experience to run this company over time. I'm not going anywhere in the short term, but in the medium term. But it takes a while to set that up and get people used to the size and scale of this company. So you all report all those ins and outs of succession. But the reality is we're a team and we're driving for it. There's a lot of talented teammates, and the board will have to make a decision someday based on the facts and circumstances at the time.
Brian, you talk about some of the new initiatives and looking forward to the bank, the Dean and the Jim that will be of the future partnering together. I'm wondering what you're hoping they can accomplish, whether it's the AI initiatives or beyond. What kind of projects you're hoping that they will spearhead?
Well, we have a lot of things going. For the last year, we've been working on some work streams to help drive expense efficiency and implementation of new technologies, and at the same time drive growth, how we take risk and continue to look at our risk parameters. And so what I'm asking them is and they've helped drive those while they've been doing their old jobs, and I've said, come do this full time, and that'll give us more leverage across the platform. Our company has a great reach. We have, we're all over the globe, and Bernie Menz and the team here out of London run all the international businesses for us. We're in a lot of countries, a lot of teammates around the world. We just announced 1,000 more teammates that we're building out here in UK, and they can help the company drive that and put the key of the top big company like ours is to work the seams, work the business connections. And so Jimmy and his capabilities as he works with the wealth management group and Lindsay and Eric on the clients that we have, especially in the higher end clients that he has relationships with who are hedge fund operators and things like that. So there's a lot of initiatives, but it's really about revenue growth, organic revenue growth, and expense efficiency, and also thinking through how technology applies. And it just gives me more power at the top of the house to join us, and these teammates have done a great job.
I imagine it's going to be United Front at the Investor Day in November, the first one in some 15 years. You mentioned the CFO, now Executive Vice President Alistair Borthwick, said this: the most important thing from our perspective is we feel like we've got an opportunity to close a relative value gap. Brian, can we talk about that relative value gap? Where do you think that comes from? What is it that you think perhaps investors don't fully understand?
Well, as you look at the company, you have a great organic growth engine. So we'll do 1 million new checking households, and our average checking balances are 3 times, 4 times the industry norm, and we're building that up. What we're trying to showcase is what Bank of America is an organic growth machine on a very steady compounding basis. So if you look at the projections for our earnings growth rates by the street, they're faster than the average company as the balance sheet reprices and things go on. But what we're really trying to showcase is to put on the table basically the metrics that we run this company by across across the 8 lines of business and how they work together, and then the international piece, and then AI and some of the other things we work on, the payments business, which is embedded in the lines of business but is a separate business. It really showed 3 things. We have a competitive position that no one else has. We just announced yesterday the largest small business lender. We have a competitive growth rate and the organic growth that's there. And then because of the dynamics of our NII lift, which it will be growing, as we've told people, 6 to 7% this year, you're going to see the EPS keep kicking in and the operating leverage come into the business, and the return on tangible common equity keeps moving up. And that's what we lay out. But it gears off that good core organic growth with the right risk that we drive this company by.
Brian, as John was just mentioning, this is the first in 15 years. Why now? What changed for you? And is this going to be a new annual thing?
I think we have 35 analysts that cover us. We spend time at all the conferences. We spend time individually. But think about it, putting on the table where the company stands right now, as we see after the pandemic and after the interest rate changes and after inflation fights and all that stuff, we see that people putting on the table where we are in organic growth and how it works together is critical. And I think, you should expect us to do it more often. We have a lot of connectivity to the people who actually own our stock and talk to them all the time. But this is a chance to sort of lay it all out so everybody can see it together. And to look at some of these initiatives that are unique, like our employee banking investment initiative, our continuum, our Merrill Edge through Merrill Lynch and the private bank, and the ability for us to take a customer literally from their first bank account their entire life, and no matter what happens to them on an individual side, or a small business forming today that becomes the largest company in the world, or an individual trader that builds up a capability and becomes a hedge fund manager. The idea of these continuums and things like that are really important. And so we hope to put that on the table and make sure people see it, and then we'd annually update it, but sort of put a baseline on the table.
So, Brian, it seems like you're moving toward a greater degree of transparency, or at least availability, at a time where the president is talking about potentially moving from a quarterly reporting system for public companies to a 6-month reporting season. Do you think that would be helpful for you as a business manager if you had to report less frequently in terms of filing?
At the end of the day, we run the company along the principles of responsible growth and how we run it. So it won't change how we run the company. It may change how often we have to talk about it. And inherently, if you do it 2 times a year versus 4 times a year, you'd save some money and some effort. But my guess is our investors are going to demand from us more constant reporting. So we'll see it all play out. It's an initiative that was talked about over the last several years. If it's going to get done, it has to be done the right way. So it remains in place. And we look forward to what comes out of the SEC in the process. But on the other hand, we are very transparent in what we do. We put a lot of information out there, things like our digital capabilities that no one else reports on, quite frankly. And again, with the Investor Day, we'll be able to show that and really challenge people to say, look, if this is what's going on, if you've taken a company that had 300,000 people 15 years ago that has 212,000 people today and applied that technology, just think as we start to apply AI more fully. We already have Erica, 3 billion customer interactions, but as that applies more fully, you'll see the ability for us to continue to manage the headcount in the company well while the revenue keeps growing. And so I think we'll report on that more often. Every 6 months is my guess, based on the demand of our investors.
Lisa, I imagine some CEOs might welcome this.
Yes.
Even if some investors don't.
They might welcome this, but will they be allowed to actually follow it by their investors? And that, I think, is what Brian is alluding to.
I think investors will demand much more transparency. Brian, I want to talk about an initiative close to your heart. The news that we got about 25 minutes ago, that you're increasing the minimum wage to $25 per hour. I remember a very early conversation with you, and this is something you're very proud of. This has gone up from, say, 15 several years ago. Can you talk to us about why you've maintained this commitment to driving the minimum wage higher at Bank of America?
Sure. So let me set 2 things up. One, over the course of today and tomorrow and yesterday, we've announced a series of initiatives. One is to locate 1,000 new teammates in the UK that will work in our operations group, and that was announced by Bernie and Tom Scrivener. A second one is to recommit to our military hiring at Bank of America, 10,000 military veterans over the next 5 years. We've done this from time. We have about 20,000 working to increase that. Another is to increase 8,000 people from community colleges to present an opportunity at Bank of America to further the career and get into skills-based training. That's a doubling or tripling of what we do today. And then the 75 branches that we're deploying and the teammates there. And the third piece is the minimum wage. And so we started on a travel a number of years ago with a view that we want teammates to come to Bank of America with a career mindset. So join us. So today we're announcing $25 an hour, which is $50,000 for a starting salary across the country, and higher in some places where the prevailing wages are higher, obviously. But what that gives a teammate a chance to join our company, spend their whole career here, and support their families. So not only is it the $25 an hour minimum starting wage, it's the benefit structure, which is a full 401k match, a full benefit cost that for the teammates in the brackets of $25 an hour, we basically dropped their premium coverage in healthcare in 2012 from $500 a month to $250 a month for family. Have never raised it to provide great health care for them, and then our child care benefits. So it's a package. So where does that pay back for the investor? Where that pays back to the investor is the turnover rate when we started this program in the high volume operations groups and the branches was 20%. It's now down to basically 10% or so, and even below that. That stability and that career mindset allows us to do a much better job for our clients. And what you've seen is the attrition of teammates has gone down. You've seen the attrition of the customers gone down, and you've seen our customer scores dramatically improve over the last 15 years due to this relentless pursuit to be a career employer. So yes, we're very proud of the $25 an hour, but there's an economic benefit for the shareholder, and there's a great positioning for the teammate at the same time.
Brian, I wonder also what it says about the situation, the current environment. It's very strange that we're going into this decision with the Federal Reserve talking about 25, 50 basis points of rate cuts and maybe more. Your team has talked consistently throughout this morning about the amount of resilience they see in the US economy. Pay hikes like this aren't the kind of things you would typically see in a recession. What's your sense of just how tight or weak, loose this labor market actually is right now?
Well, I think if you think of 23 summer, the Great Resignation, it was very tight. Then it loosened up, and it's more imbalanced now. So our turnover rate in our company is running about 8%. Even in places like tech programmers, of which we have 30, 40,000 of them, we're running in double digits is now in 3-4%. And what that shows you, the bid in the market's different, which then shows you people are being more careful at headcount. And you heard some of my colleagues talk to you about that. So I think the unemployment rate is still low, but I think businesses are being much more careful in managing their headcount for a number of reasons. One is to get by understanding how all the policies that are coming at them fit together. I'm talking about U.S. businesses mainly. And then secondly, they're also making sure that they're careful, and I heard some of my colleagues talk to you about this earlier. As you think about this application of technology, we know what this does. We have half as many people working in the consumer business than we did a decade plus ago. We have half as many people working in operations. We know that as these technologies can apply to our legal department, our accounting, our finance department under Alistair, our risk department teammates, we know that if we manage the headcount carefully, we will do it. So we look at headcount very carefully and say, don't hire people unless you really need them. Not because we're trying to save money, because frankly, from a human management capabilities, we don't want to have people who won't be able to have a career here. So we just hired 2,000 plus kids from school. So we brought in all those new talent. We'll hire these 10,000 veterans. We'll hire these 8,000 people from community college. But each month we get the right to make a decision on whether we're going to hire about 1,300 to 1,500 people, and we're just managing that very carefully. So I think we're an example of what's going on in the broader labor market. You heard Wendy and my colleagues talk about it. All the companies are trying to manage this and make sure they get the headcount right, because that is a major expense for a lot of firms.
Brian, about a year ago, you were talking to us about the ramifications of AI and the explosion of efficiency. And you said that you think that headcount could remain about the same at the bank, even as the business continued to expand just in total size. I'm wondering if that's shifted, if you still see that as the natural progression of the relationship between the adoption of machine-based learning and the relationship to your headcount.
So there are two things. Now, one, I think the time we were talking, we were probably closer to 216, 17,000 people, or 213,000. So I think we'll be managing this down. But remember, at the same time, we're managing out through operational excellence and efficiencies of applied technology. We are deploying. So we're adding, Wendy's added commercial bankers in all the markets, and Sharon and the team added business bankers in all the markets, and Katie and Lindsay and Eric adding financial advisors and private bankers. So we're adding front front-end people, sales traders, et cetera, to keep building out our capabilities. And so there's a reinvestment going on. The key to that is really redeploying people and reskilling them. So when we bring these 2,000 plus teammates in who just joined us in the last month and a half, we have to be more mindful about training them along multiple dimensions than we might have been 2 or 3 years ago. So I think, yes, I think ultimately the human being content of our work product would probably come down, but if we manage it right, it'll be flat to the same amount of people, maybe down a little bit, but all paid more and all being applied to the highest value tasks where, frankly, the machines can't do the work. And that's the important thing. We know what this AI can do in today's world. Erica has been out there for 7 years, 3 billion customer interactions, 20 million customers using it all the time. We see what it can do. We took that and put it in our commercial business. We took that and put it in our internal process. We got other models to help in Jimmy DeMare's business in terms of a thing called Optimus and things like that. There's a lot out there, but what you're learning is there's still augmented intelligence, and that will be what's driving the near-term efficiency. So yes, I think the headcount management is one of the core tasks that managers have to take seriously.
I'm just wondering, Brian, as you train all of these new students, how do you make sure that they stay with you and don't go to some of your brethren across the way in the private asset sphere?
Well, we provide them a good opportunity, and look, they can go other places, but we've been able to retain enough that we're completely happy. And look, even for our clients, frankly, if they hire our teammates, it's not the worst thing that happens in all our businesses. But the reality is that we want these teammates to have a career mindset. In October, I'll celebrate our teammates have been with our company 50 years, 55 years, 60 years, et cetera. And you hear their stories, and their stories of I joined this company, I worked in a summer internship, I may even work part-time during college, I became a full-time employee, and I started doing this, and now I do that. And those are wonderful stories. And we have them tell those stories to our teammates to show you that you can have a long-term career at a company like ours, and that's what we want our teammates to come in with. They may not stay in trading or investment banking or corporate banking, but they'll have long-term capabilities here. And you've seen that even at the top of the house. Alistair was a capital markets head, and now he's the CFO, and so that goes on throughout the company.
They swear an oath of allegiance.
Yes, exactly.
Didn't you see them lining up this morning?
They came in.
Before they come in.
I promise on my cappuccino, which is very good, by the way.
Brian, I want to talk about the main event that takes place later on this afternoon. I'm not going to ask for your guess. I know how much you respect the team behind me and some of the official forecasts of the bank. I want to understand from your perspective, looking across the 8 lines of business, whether you see an economy, market activity that demands a rate cut from this Federal Reserve.
Well, you've had the benefit of all our experts, and we have the talented, extremely talented research team, and you also have some in line of business teammates talking about what they see out there. I think you have to back up. If you think about last year this time, the projected growth rates for our team was probably 100 basis points higher than it is today for 25. And so that deceleration of growth, the prediction that was largely based on a couple things. One, rates would stay higher because inflation was kicking in, the impact of the uncertainty in tariffs, et cetera, et cetera. All that's coming through the system now, so you're seeing some certainty fall into place on this. And I think also inflation was coming down, and I think so the tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind, the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that. So you hear our teammates talk about the economy growing back out. And that then means we're on the other side of it. And so the Fed has to adjust to the inflation picture as it got more in control. They can come down. They came down 100 basis points already. They can keep coming down, but they got to be very mindful of the inflation side. And so I think when the people get in the room and they see the data, they have to think it through. The big news since that you referenced earlier was the labor market's gotten softer, so that gave them concern. So I think the market believes and our teammates believe they'll cut rates. But I think the key for people is deceleration of growth, and will the growth reaccelerate? And you hear our teammates seeing that. We're seeing consumer spending strong and all those things, which would indicate we'd see the acceleration. Next year's better than this year. Unemployment is not expected to go up a lot, even though the employment picture may be softer. But the most important thing is the long-term interest rate scenario people projecting is a more normal rate environment that we saw before the financial crisis. Say 3% plus plus or minus on the Fed's fund rate, 4 to 4.5% or so on the 10-year rate, and a curve that's not inverted, that's normalized between that. The important thing is to get back to more of a normal environment, frankly, with maybe a little higher inflation, because the great debate about 2% is something you can get lots of experts talk about. A little higher inflation, a little faster growth, and then, frankly, that'll help with some of the debt carry and other things going on in the U.S. economy.
Brian, it sounds like next year you see the bigger risk as potentially a surprising bout of inflation and some sort of downturn. Is that correct?
Well, I think the question is how do you tolerate the inflation and the nature of it, what's come from. But, and I think that's the tension of all this, I think, is next year as you get to the second quarter, as these policies are now in place and are behind us, are you going to see the acceleration in growth and where our businesses start investing even faster? If you listen, I think if you asked Wendy about it, she would tell you her commercial customers that have lines of credit are still borrowing less as a percentage of their availability than they did in sort of the 17, 18, 19 timeframe, where rates have been moved up and the economy was growing. And so why is that? They're probably not seeing quite the opportunity, and so they're trying to sort this all out. And I've got the benefit and the honor of leading a company that has this talented team behind us, and all the talent and money we spend on research and everything. If I'm running a company that the three of us owned and it was a manufacturing company, I got to figure it out all myself. That tends to hold people back. So that would be the case for acceleration. And then the question is, if rates stay a little higher and the growth is higher, that's not a bad place for America to be.
Brian, just before you go, I wanted to sneak this in. One final question. Whose door do I need to knock for World Cup tickets? Who makes that happen here?
Well, you didn't bring David Tyree on, who's doing all our marketing and work, and so he's the guy that's got control of the tickets, but he does a great job for us. Look, our relationship with FIFA, we did you had the Club World Cup, which was sort of the warm-up, and next year, and you'll see us accelerate our efforts. We have great capabilities for our clients, but most importantly, this is a chance for America to showcase football, soccer as we call it. It's a case for these cities that are hosting to put on a great show, and I think I can see the enthusiasm building, and you're not the first person that's asked for tickets, John.
David Tyree. David Tyree?
Yeah. Come on down.
Brian, thank you, sir. Appreciate it, as always. It's good to see you. Enjoy London. Brian Moynihan there of Bank of America.